Hey guys, so this is about the pre-course. Like I've said, we had a couple of questions that I proposed to you guys to determine how you can actually just only use the chart using price action and volume to determine trades and how to conclude and search for confirmation basically. So in this pre-course I will be talking about momentum. In momentum, we have a couple things. We have price action, and price action. What I mean by that is candlestick interactions, and what I mean by that is formations plus reactions and plus relative body. The other thing we talk about is volume and what volume says over price, and the other two things are momentum indicators and order flow. I won't be talking about momentum indicators or order flow because this is a different concept in my opinion. So I will only be talking about price action and volume and how you can actually use these two to determine certain type of trades. So the questions were study how zones or levels interact with price, what this tells about the price, and where is price weak and strong relatively. And the other thing was where would you have placed your entry, your exit, your stop loss in hindsight, obviously, but that's the purpose to form a clear mechanical thinking. And how many trades would you have placed in total in a time span of 2 weeks, and how did intraday traders get wrecked? So where do we start? Is we actually start at the beginning on the left side, and we see all these different zones that I marked, and these are all zones that interacted and they tell a story basically. So we start on the left basically here, and the first thing we notice is that we see price expanding and we see actually volume expanding. And here is a first criteria basically. A strong volume is a strong candle mostly of the time if a market is trending basically. If there's strong volume and the market is trending, most of the time it's a strong candle. This of course, you can't apply this when a market is trending sideways because it's not trending, it's going sideways, so it's consolidating. And this is actually the majority of the time, price is mostly consolidating. Another thing is then more volume means that there are more participants in the trade. And a price that is declining with increasing volume means that selling interest increases based on probability. The seller increase is bigger than the buyer increase. So what we conclude about that is that falling price with volume increases is bad basically. We can also use a contra definition of this, or an inverse reasoning, I don't know how you want to call it. Selling interest is dominating, but the amount of dominating sellers decreases. Therefore, sellers become hesitant and buyers get more chance. And otherwise we could say declining price with low volume is easy to reverse for bulls. Another thing is increasing price with low volume is easy to reverse for bears. So you can like mirror this basically and should be able to determine what is happening. So one thing we can say here for sure is that now obviously volume is increasing. If you can't see that, you're completely blind. And I'll give you an example. You have this guy, Texas West Capital, or Mr. Inks, Christopher Inks. He completely ignored this for his followers or his live watchers. He did not. He was always the guy who says like, okay, volume precedes price, and it does. Volume precedes price. And volume is basically the energy that moves price. Without volume, there is no price that is moving. It's the most critical thing. But volume on itself doesn't say anything. But you need it in context. So you can't say a volume is low, a volume is high. No, in relation to what? You have to determine the volume based on interactions that happened right before it. So that's how you give context. And it's the same for price action itself. Candlesticks basically give a simplistic version of order flow. And however, the data implementation is completely different. So what I mean like candlesticks give a simplistic version of order flow. However, data implementation is completely different. This is maybe a tricky thing, but you shouldn't pay that much attention yet to it. Another thing is that relative body. What we mean by that with a relative body is that compare a candlestick with previous candles and how it performed relatively. So we compare it and we try to give it context, because you can't just say this candle, oh, this is a bearish candle. You can't say that, because you have to compare it to what happens in the past or happened in the past. And this is how you give context or confirmation or that kind of idea for the price. There's another thing. If price goes down, the problem is for most people, they use a volume indicator and they only look at how much volume increases or decreases to determine if it's bearish or bullish. And this is completely garbage or incorrect, because volume is cumulative. So what I want to say for sure is that if you use the volume indicator, which you should obviously, because if you don't, how can you trade? Anyway, that doesn't really matter, but it's a critical thing to have volume on your charts basically, because the volume gives it context, and it's the big energy that's driving the price. But another thing is that the volume gets the same color as the candlestick. So what I recommend to do for especially beginners, or especially people that are not that used to trading, that they don't really get caught up in color, which is also psychology basically, is that you use a black-white candlestick formation. That's just, I really recommend to do it. If you don't, like, it really does do something that really does something with your thinking. But looking at volume, in my opinion, volume should be just one color only, so you can't discriminate if it's like because of the color, it's bearish or it's bullish. No, you can't do that. You have to compare the volume in context to what happened previously, and you can determine with the volume if price is strong or weak based on that moment. So I give just an easy explanation here. Obviously, price is strong here. Doesn't matter if you look here, strong, and it gets actually stronger. And here it's still strong, because you see this enormous wick. It means that there's a lot of bearish pressure. So it does show it's very strong here. Price is strong, shows a strong reaction. Okay, so what we said, like in these 2 weeks, there's a couple of trades you should have been taken. And this is something we're gonna discuss a little bit later in the video. But we're gonna start on the left, and we're gonna try to give these candles context. We're gonna see how price interacted with the levels, and basically the questions. We're gonna slowly go past them. So this here, you see a strong move, and then suddenly you see a very strong move, and you see it tries to consolidate. And then, so this candle already gives you a signal, okay, what the hell is happening? You see this price expanding, then you see the strong wick upwards, and you see a massive smash down, but you see price closing inside of this engulfing candle, basically this bearish candle. And then, okay, that already gives you a signal, okay, this is consolidation. And then the next candle shows also the bullish pressure with the bearish pressure, and again, the close, the fair value stays the same. And you see this hovering here, and it's actually trying to gather momentum to push the price down forward. You couldn't directly, based on this, you couldn't say, okay, price is going to go down. We did see lower highs, of course, but we're going to not use that right now. We're going to look here. What we saw here is that we saw consolidating, we saw all the candles close on the same level. And then we saw this bearish wick, or this gravestone doji idea. And this actually gave you a signal, not directly to go short, but that price is most likely to go downwards. But we also saw the volume completely fading away. So there was no momentum, basically, which is a tough one. But then we had this enormous bearish engulfing candle. And this kind of signals that this is a very strong move relative to what happened here. It's a very strong move. This is a very strong move relative to this. And all this is, of course, stronger move than this, stronger move than this, and stronger. So it's relatively strong. Okay? So we have this bearish engulfing candle, and what we see here is that we see candles getting smaller, and we see the closes come at the same level. So a fair value is determined right here. And then we see this liquidity tap or stop run or punishing the shorters basically. But what we see here basically is that they try to punish the shorters, and it's gonna come a little bit later. But we see the fair value is determined. I see price closing here, and then you see this demand zone, which actually determines from a level in, I think it's November 2017 on a weekly level basically. So this was actually a possible trade that you could have taken, but let's say you didn't took this because there is actually the odds, because you didn't really know what happened here. But what I'm gonna say about this, like fair value, it stops at the previously opening, as you can see here. This one stops at the previously opening, open, close, open, close. So it close the previous opening, and this could be a stop run, it could be a liquidity run, just to punish shorters, but I will go in depth later about that. What this does signal is that there are lots of buyers and sellers participating. Like I've mentioned before, more volume means that there are more participants in the trade. And since we don't see price declining anymore, we actually see it like slowing down. It signals that lots of buyers and sellers are participating in the trade. It doesn't say much about the context. Price didn't close lower or higher basically, but it does say a lot about activity, what's happening here. So this candle alone doesn't give us context to what happened here, but it does signal us what kind of activity is happening here. So we know that there's lots of buyers and sellers debating, okay, what way we're gonna go. Okay, so after that, we actually see a wick here. This demand zone, which is predetermined based on the weekly. Around November, we saw a weekly demand zone, and that's why we saw this liquidity tap in it. So it couldn't be a stop run, basically. Okay, after that, we see price going up, and we see these three, and we can actually, let's say we're not looking at this one, so we're only looking at these two on the left, because the third one, we don't really need it to determine it. But we see two very bearish wicks with this kind of doji again, gravestone doji, and it actually signals us that based on, look at this volume, by the way. We saw this volume before this, and then we saw volume here completely fading away. So what we know here on this gravestone, whatever candle you want to call it, is that it's very weak based on the volume here and the volume here. In context, it's a very weak candle, and it means actually that the bulls are out of steam, and because of the bearish pressure here, and so it's very likely to reverse just based on these two candles. And what we see here, we see actually volume coming in, and we see getting more bearish, closes below this basically, and that's confirmation for the bears to push it down again. So what we see after that is we see all these wicks in this demand zone. Okay, we see a wick into the demand zone. Buyers weren't really dominating based on the wick, because you can see this wick here. You see lots of buy pressure, indecision basically, and we see buy pressure, but we don't see dominating. So price basically tapped liquidity because of all these buy orders that are probably stacked by market makers in this pool, and it keeps pushing the price upwards based on 1, 2, 3, 4. So it's actually fair zone, and it's based on a weekly, so it's pretty strong. Then we see this reversal idea, and we see this higher low, and then we end up at this daily OB zone that's predetermined based on this. On the daily, was given by me. Lots of people weren't able to determine it, but what do we see here? we see a daily OB liquidity tap, but we don't see price closing above it, and this is very critical. By the way, I'm not using the 236 level here, which was actually a reason why we didn't close above this. So we had this interim resistance based on this here, this wick here. You can't see it because of the red bar, but we had interim resistance. We got rejected, and when we saw a very weak buy volume, so in context, it was confirmation for the price going down. So back here, we see this liquidity tap. We see price closing below the daily OB. And if I go to the 1 hour, gotta check. Yeah. So on the 1 hour, you still saw there was no close above, but it looked pretty strong. Basically, it looked pretty strong. We saw some volume. We saw it declining though. We saw a new high. We saw it declining. We saw some closes. But there was no direct pulse down yet. So we had this level determined in advance. So what I mean by that, we had this level determined in advance, but we didn't saw a strong pulse down. So the candlesticks directly on itself didn't really say, okay, this is going to go down, but we did saw the close below the OB. So we still had a signal, okay, this is very likely going to be a decent short position to open up a short. And the moment we got confirmation, we saw these bullish wicks here actually. But there was this candle here. And this is, you got to look carefully, of course, because in context, we saw that this candle here, which closed below it, had bullish pressure, was completely fading away. So it got really weak. So price got really weak. So the levels here completely became unsustainable for the bulls. So the bears were just waiting for the bulls to losing their strength, basically, and then they punished them. And what I mean by that is then when you saw this engulfing candle, the moment when they broke the support, price reacted quite strong. And then we saw this here. We saw hesitation, basically. So this was actually a moment where you should be taking profit. There was hesitation here, a tough one. But then we see a strong reaction, actually. And then we saw right here, this is a good one, like, because you don't see a lot of volume. Volume keeps decreasing, by the way. In context, volume starts fading away. There's not much participants in the market anymore, so people are basically leaving the market. And then what we saw here, we tapped the daily OB, but we see a very strong rejection. And we don't see that much volume, but in relation to the previous candle, we do see more volume. So we do see a strong rejection. The bulls didn't fight back. So a trend started based on this lower high. A trend started, and it was a very strong move to the downside. So this was actually a tricky one because the volume is not that high, but in context to what happened previously, this candle told that there was a strong rejection. There was more participants in the market than previous candles. So we have some kind of confirmation for an impulse down. So after that, we saw this decently bearish candle, but it wasn't the most bearish candle. And we saw this, there was a 4-hour pivot, if I remember correctly, an interim resistance. And the moment when this broke, so we already saw this bulls got rejected, bears were dominating. We saw this 4-hour pivot. We saw this like hesitation, and the moment it broke, volume starts to come in. And you see that the volume increases, and then the moment when we tried to retest, but we failed to close above it. We closed below it. The bears had confirmation and they shorted again. And you see volume actually increasing. So if volume precedes price, more participants in the market basically, and the selling interest actually increases. And what we see here is something tricky as well. So this is a tricky one, I would say. What we see here, right here, is that we see bearish engulfing basically. We see doji, and we actually see momentum fading away. But then we see a tree line strike basically. So we see this engulfing candle that devours all these 3 candles. So this one is relatively very strong compared to this, but then we have this sort of kind of inverted hammer, and we call this what do we call this? I think we call this a shooting star. Yeah, you have this tree line strike. So basically this one devours these 3. So everything that happened basically just got eaten away by the bulls. But then we saw this massive rejection to the 4-hour pivot. And this one actually closed below this one. And it made a shooting star formation, and it actually made this bullish candle look weak. So again, engulfing candle is very strong compared to the tree line strike. Then we have this inverted hammer, makes the engulfing candle actually look weak. Also, you see the volume, which is slightly more than this one. You gotta pay attention, because we had this one, volume increases and decreases, and we have this, and boom, engulfing strikes this all away. And then we have this rejection, which actually shows that bears are back in control. And another thing is momentum is weak and the move is strong. You gotta understand, like, move minus momentum can be strong. Price action on itself tells nothing about the strength of the move. A volume on itself says nothing, but price action plus momentum times time. So price action plus the momentum times time. Okay, so then we have this interaction right here. So we had this rejection, which was actually pretty strong. It was a strong move compared to this one. And then we have this continuation, and then we had this 4-hour pivot again. By the way, we saw, completely forgot to say, this was actually based on the 4-hour pivot. We saw strong reaction, and then we gave it, we gave all the bears power back. Then we had the strong rejection to this 4-hour pivot. After that, we had this continuation of the downtrend. And what we saw here is that we saw the 4-hour pivot actually react. But the weird thing here was that we saw the bears were in control, so volume increases. And the moment it hit the 4-hour pivot or the support level, it basically fade away. So as you can see, like, we saw bears and then it fade away. So we saw a very weak reaction. You saw this liquidity tap. So at this moment you saw, okay, close above, and okay, strong reaction. So after that we saw again this kind of type formation, and then we broke it. And we closed above the 4-hour pivot, and the next one engulfed it, and you see this price volume again increases, and volume precedes price, and you see price just moves with it. You see how it increases, it's very visible. Okay, so what we see there, we see this reaction here, which is actually a strong reaction to the 4-hour pivot and demand zone we had established in advance. And basically we see price and boom, and then what we're going to show on the 1 hour, because it becomes a little bit more clear, and is why it actually shows why the 1 hour and the 4 hour and the 6 hour should all be combined to give context to each other. What we saw in the 1 hour here is that we saw this consolidation, bearish level, we broke below the green level, which was predetermined, and then we saw bearish in control, and then we bearish, and then suddenly it faded away, it kept closing above the 4-hour pivot, and then we saw like a big candle, lots of wicks, less wicks, and an inverted candle, very, very small, and then boom, we gave it all back. And this is a moment where intraday traders completely got wrecked, because they were fighting the trend on the 6-hour time frame, where we formed a new low, but we still needed a lower high, and that's what came afterwards. And then we have this candle here, which was actually a very strong bearish reaction. We closed below the level, We didn't make a new high, but this candle in itself has no real context because it basically was a fake out. So this wick was completely not meaningful. So you can't really use that in your TA. If you do, I don't know how you determine it, because it was nothing more than just getting intraday traders wrecked, and it was a fake out stop run. So we had this move, and we closed below the demand zone, which signals that you should get into a short position. So now we gave a brief explanation about the candles, what happened, basically, and so I'll go over. I gotta check the object tree. Let me check. We're gonna do first. Okay, first we're gonna show where price was weak and strong. What does it do? So slow. Well, obviously there it's weak. Okay. Object tree. A couple more. Maybe this one. Okay. Let's do it like this. Okay, so there you go. So like I've mentioned before, is that we saw that price was pretty strong here. We saw the volume increases. Price pretty strong here. Price is strong, relative strong compared to here. Relative weak compared to what happened here. Relative weak compared to what happened here. Relative strong compared to what tried to happen here. It was a very strong reaction. This one was a very strong reaction as well. So this one was a very strong reaction compared to this, but this one was a very strong reaction compared to this as well. But this one was a weak one compared to this. But you can't really determine this one because this one happens after this one, so you can't say this one was weak compared to that. But that's why this is very strong compared to that, okay? And then you have this one, is it? I have it. It's very strong. Gotta check something. Yeah, this was a pretty strong one because of the wick, the bullish pressure. And this one was actually a decently strong one as well. Then we have this one, which a very bearish candle, inverted hammer basically, also a very strong reaction. So I'm gonna take these ones off again. And then we're gonna go to the next one. Okay, so the next one will be going to talk about the risk to reward on the first trade. So okay, so we're not taking consideration this trade, but we're going to talk about this one. So we had this this is a fib retracement from this and this, and this risk to reward is 2 to 1. But the idea is that we don't get stopped out basically, and we take really good trades based on the confirmation. Because we knew that this, we could have actually shorted this one, but let's say we didn't, because we didn't really have clear levels determined yet. We didn't really have a range. So we saw this was a very strong reaction, and this was a very weak reaction for the bulls. And then we saw the downward pressure. We saw the demand zone, so we, based on that, we took an entry on the level that was predetermined basically. Also the candle closes here, and we took the entry, and what we did was a stop loss. Could have been below this wick, but the reason why we don't do that is because we could have got a liquidity tap lower to run the stops here. So what we would do is get the stop loss level at either the extension of this entire move to the 1272, or we took the green level that we predetermined, which was 3490, and that gave us a risk to reward to 2 to 1. What you could have seen is that if you took this long trade, is that the first profit taking was at this swing low, which was from this candle, and the swing high, and also a 236 level. We didn't close here above it, but that doesn't really matter. We did first profit taking, so we had a very good trade here. 2 to 1 basically. Nothing wrong with that. So let's go to the next one. The short trades. I don't really know what's happening, because somehow if I try to adjust things, it starts to freeze up or something. I don't know. Pretty weird. Okay. So the first short, based on this demand zone, or the order block, my excuses. Sometimes I have it wrong in my head when I try to say it, but we first have this order block. With the 236 level, we had lots of confluence to actually predetermine, or we have the levels were given in advance to participate in a trade, and we also saw this very weak reaction here compared to what happened before. And we saw volume decreasing, so less buyers, less participants in the market. So we take a short entry, but we could have said, like, I'm gonna try to take a stop loss above this wick, and I wouldn't say so because you have at least this wick, but it would be far more safe to do it before this entire move started downwards. So we look at this one and do use this as a stop loss right above it. So we take this candle close here. Then we take this candle close here as a target, and it gave us a 2.84 risk to reward. A very good trade, basically. 5% stop loss, 15% profit. A very good trade. So let me hide this. And then we would have said, like, okay, let's say we took profit here. And then we would have get the other one. So hide, and then we have this one. So okay, because after we took profit right here, we took profit and we lowered our stop loss to this wick. So our risk to reward changes from 2.84, 50% profit taking or maybe more, to 6.53. So 6.53 plus 2.84 is like what is it, 7.5 or something? No, it's like 6.53 plus 2.84 is like around 9 point something. So we had an average of like 4 plus risk to reward. So very good trade after the profit taking. So we hide this. Oh wait, yes, we hide this. Okay, then we have this very strong rejection, and it could be the case that you actually missed this trade. And then we had a re-entry level when we get back here and we get above this the open here of this candle. So we take a wick here of the bullish candle. We have the stop loss still at the same level, and we still have the same target point, which gives us a 2.16 risk to reward. Still gave you a pretty good short. Let me hide this one as well. This is awful. I don't know why the chart keeps doing this. That's stupid trading view. Risk to reward short. That's a long, okay. Okay. So, this is a tricky one. Based on this entry, we took partial profit here based on the close. And then we moved the stop loss to break even, just in case, because we had this interim resistance and 4-hour pivot here. I don't know where it went, but it's somehow gone. So we move our stop loss to break even, just to make sure we don't get stopped out. Then we had a re-entry basically for a short based on this candle close, because we had this this 3 strike basically, and then we had this shooting star. So if we were able to get the close of this candle, we shorted with a stop loss at this candle here, this doji, or this kind of doji, and we gave the demand zone as risk to reward, or as target, and we still had a 2.38 risk to reward, still very good. So we can take this one, hide it, because we had to de-risk it at the demand zone. And then we had this trade here, the moment when it broke. So let me hide this. Hide this. So we had this trade here. The moment we broke this 4-hour zone and the demand zone, or actually when we closed below the 4-hour pivot. So we first had a liquidity tap at the demand zone, we failed, and then we closed below it, and it was your confirmation to go short. It already was pretty weak to start, because we saw this volume gaining, and then we saw this, no interaction basically, and then it closed below to add a volume increase, and that was actually your signal to go short. And then we had the previous predetermined level of the 4-hour demand zone and an extension and possible historical level. Very easy trade, basically 3.21 risk to reward. Very good trade actually. And you would have been de-risking here at the green level, but when it closed below it, when we had this target, then it was a pretty clean trade. And then we had one more long entry. Okay, this is a tricky one, but we had this long one with a predetermined level. Let's say we didn't were able to capture this one directly because we took profit over short. Then we had this with the higher low formation. We will be entering on this wick. Then based on this candle wick here and the wick here, we use a fib retracement. We determine our stop loss because we see a liquidity zone here right below it. And we place it right below the 3235 level. And we take the 1272 level just to make sure we don't get stopped out. We still had a 2.9 to 1 risk to reward, just if we hit the demand zone or the 4-hour pivot again, which we did. Was a clean trade, didn't take a lot of effort. Perfect. Okay, so these were the trades you could have been taken. So there was a total of there were quite some trades if you think about it, but still in like a 2-week time period, there weren't a lot of trades that you should have been taking. And if you took a lot more, you should have really checked if it was the good thing that happened. And on this one, I just want to say, like, here we saw a quick add-on. Sellers were suddenly gone, basically. The support was pretty strong demands on. The group psychology, sellers are hesitant and will wait. They see bulls didn't push heavily, so they take another attempt. And the buyers failed to hold at a significant level, the 4-hour pivot and demand zone. The moment it broke, the volume increased, and so more participants came into the trade. Something that I just want to make sure that I talks about it. What more? Okay, so the trades that you should have been taking are all gonna be visible here. 1, 2, 3, 4, 5, 6 trades. So this one was the short entry based on the inverse hammer. It could have actually be 7 or 8 based on these two, but since we didn't really have that much information yet, we did have this wick here, this and that, but just based on this is a 2-week period, you should have been only taking 6 trades basically. 6 trades. And everything I discussed here with the risk to reward was actually de-risking your short or the trade you were still in. So you've only taken like 6 trades, maximum of 7 or 8. Everything more, you gotta re-look at your game plan. Like really, you gotta recheck your game plan, because did you really look for the confirmation? Did you look at the candle closes? Did you look at the predetermined levels? Did it interact? All these questions in your mechanical thinking are really important, and this just shows that there were only a sum of 6 trades basically. It were like 7 or 8. I'll be honest, 7 or 8. Maybe this one could have been a 9, but it's really that's really stretching it. Okay, that's really stretching it. So I would say 6 trades. You should have been taking 6 trades, especially when you're not an advanced trader. You should have taken less. If you took more, you got to really look at your game plan. You got to really look at your risk, because I showed you the real risk in the trades, okay? Because you can say like, oh, okay, I'm gonna enter here and a really tight stop loss above the wick, but that's not a trade. That's just trying to gamble. Okay, hope I'm not gonna stop out. It has to be very logical. Okay, we have this close here. This was a very certain kind of demand zone, or the order block, daily order block. So we place a stop loss right above it, and that's a reasonable trade. Because you gotta take in consideration, okay, where do I invalidate my trade? Because your stop loss is nothing more than invalidation. Okay, so another thing, I'm gonna hide these ones. Where are intraday traders wrecked basically? And this is kind of just a bonus, but yeah, this one, and this one. So okay, here intraday traders are completely wrecked. Here intraday traders are wrecked. Here intraday traders are wrecked. I think I'm missing one, aren't I? Ah, sneaky. And this one, yeah. And this one, intraday traders are completely wrecked. So what I mean by that is, if you were trading on the 1 hour, like I've showed you here, if you were short here, still like, I don't know what the fuck you are doing, man. But you gotta be serious. I'm not gonna discuss what happened here, but I've already discussed like why you should have taken this short. Then at this green level, partially profiting, we broke it, closed above it, partially profiting, and then we had this trend line resistance or support. But we don't need that to determine based on price action what is happening. But what we see here is volume. Okay, gotta pay attention to the volume in relation to what happened before. What I'm gonna add to this? Let me think a second. So this is an idea of what's gonna come. This is not really directly what the course is gonna be, but this gives you a kind of reasoning in the thinking process. That's what I will also post a chart with like notations. I've already posted one before. So this gives you a brief idea what a small part of the course is going to be, because the first thing that I've explained is of course a part of the course, but what I've evaluated afterwards is not what's going to be in the course. But what I want to say about this is, like, in hindsight you can still look at the trades, because the only thing you use is the candle and the candles before. So based on that, you can still use hindsight strategy or determine or confirmation to see if it's logical or to see if it's a trade. So a couple things. If you traded more than 8 or 9 trades in these 2 weeks, and I'm actually gonna say 6 trades, if you did more than that, You gotta really look at your risk. And another thing is like a lot of people try to trade intraday, and yeah, I know it's fun, but I think it's also very dangerous because I think most of the people don't even know what the fuck you're doing. Okay, that's honesty. People think like, oh, I'm gonna trade intraday, this and that, because they just want to be in a trade all the time. They don't understand. They like, if you're trading intraday, there are so many things you got to be aware of. There are so little errors you can actually make, and I say for myself, I believe I'm a pretty decent trader, but there's so much risk involved trading intraday. You shouldn't be doing it. Listen to me, man. You shouldn't be doing it yet. If you're trading less than a couple of years, you shouldn't be trading intraday. You're not ready to do that stuff. It's reality, and this is a thing a lot of people don't want to like admit, because they think, okay, I win a couple of trades and they're on a good winning streak. But even with my win rate, I don't trade intraday anymore. A couple times I trade 1 hour or lower. Like, yes, you should use lower time frames to get into an entry and determine a little bit of momentum and order flow, but the grand scheme should be on the bigger picture. You should be looking at the 4 hour, 6 hour, and the daily time frame, as I'm referring to as meso time frame. And it's very, very important that you stick to that, because the moment you start to zoom in these lower time frames, you get caught up, man, and you get caught off guard, and like moves like this totally wreck you, man. It's like, if you're trading intraday and you're following the trend and you don't respect what's happening on the 4 hour or the 6 hour or the daily, you're gonna get eaten alive. So make sure you don't overtrade for sure. And this just shows you a clear example that if you traded more, you gotta reflect on yourself. It's very, very important to reflect yourself and look, okay, how many trades did I do? Why did I took those trades? What this and that, and was I trading intraday? Yes or not? And if that's the case, and if you're not really experienced, take my advice, man. To really take it. Try to slow it down, because this game, you gotta understand, the smart money has a couple moves they're making, and they know how to wreck intraday traders. They know how to take the money of the little guy. And if you're willing to participate that, you're willing to gamble against them, go ahead, but you're not gonna sustain for a long time. That's reality. I hope this was useful. I would really like to use feedback. You gotta tell me if you guys want to see more stuff like this, and then I will be pushing more content for sure. The first part is obviously part of the course. It's a small piece. There's a lot more gonna be involved, but I want to give you guys a kind of idea what are we gonna talk about, and yeah, it's also like if it's gonna be worth my time, because it has to be worth your time and it has to be worth my time. So I gotta need feedback to make sure that I adjust certain things. If I made mistakes or this and that, you should let me know. It's very important for me. And yeah, I thank you to watch this, and I hope it was useful. And I will reflect everyone or give feedback to every person that actually participated in this. And it's very important. So take care with trading, and make sure you don't overtrade, and make sure you respect intraday levels and meso time frame, and don't trade intraday that much. It's fine to take a couple small trades, but make sure you manage your risk. But you know that if you're trading here and you're shorting here, you're taking so much risk. Look how much you would have give back. Just saying. Okay, so take care and have a nice day.